A bold shift is taking place in the global financial landscape, and it's time to pay attention. The once dominant yen and dollar are facing a crisis of confidence, and a new player is stepping up to fill the void. Get ready for a fascinating journey as we explore the rise of the Swiss franc and its potential to reshape the world's financial markets. For over 7 decades, the yen and dollar have been the undisputed kings of global markets. But now, their reign is being challenged. The yen, once a symbol of cheap money and a powerhouse for global carry trades, has lost its shine. The Bank of Japan finds itself in a policy quagmire, inflation remains stagnant, and the USD-JPY exchange rate has soared beyond 160. What was once a safe haven has become a liability, and the market is moving on. The carry trade, born in Tokyo, thrived for over 3 decades as investors borrowed yen at zero interest and invested in high-yield assets. However, this structure began to crumble in 2022. The yen plummeted to 150 per dollar, credibility vanished, and volatility skyrocketed. In January 2025, the BOJ finally took action, hiking rates to 0.5%. The highest in 17 years. Why? Because inflation was no longer an illusion. Tokyo's CPI surged past 2.5%. Food and energy costs soared, and domestic demand finally emerged. Add the pain of higher import costs due to a weak yen, and zero rates became unsustainable. Economists now expect another hike to 0.75% before the year's end. The dollar's problems are equally concerning. Once a safe haven during market scares, the dollar is now being used as a political weapon by Washington. Tariffs on rivals, sanctions on Russia, and trade disputes with India and others are all part of a strategy to maintain dollar dominance. But politics has a way of backfiring. Instead of tightening its grip. This approach has pushed countries to explore alternatives, such as oil deals in yuan and sovereign debt in francs. The IMF's KOFR data for Q1 2025 shows the dollar's global reserve share slipping to 57.74%, while the pound dropped to 4.7%. In contrast, the Swiss franc, though small, is gaining ground for the first time in over a decade. This shift is symbolic, indicating that the franc is no longer a niche player, but a credible alternative. The data paints a worrying picture. Job revisions reveal a loss of 911,000 jobs. Nearly 1 million paychecks gone. August payrolls added a meager 22,000 instead of the expected 75,000. This is not a slowdown. It's a halt. Unemployment remains stuck at 4.3%, and inflation is not easing. CPI jumped 2.9% year on year, while core inflation held at 3.1%. This is not cooling. It's re-accelerating. And here's where it gets controversial. Markets still expect the Fed to cut rates this week, even as inflation ticks higher. Apollo, a Wall Street giant, warns that this setup resembles the 1970s, where inflation dipped and then roared back in 2 brutal waves. If the Fed eases now, it risks falling into the same trap. Weaker growth, hotter prices, and a deeper loss of trust in the dollar. History also teaches us that market crashes often occur not at peak rates, but right after rate cuts. When the Fed blinks, it usually indicates that the economy is already struggling. And that's when confidence truly unravels. As the yen collapses as a funding source and the dollar loses its safe haven appeal, the market is searching for a replacement. The euro is stuck in recession, and the old anchors are gone. This has created a vacuum, and the franc has stepped in to fill it. In 2025, CHF surged 11% against the dollar, while EUR-CHF hit historic lows. Normally, such a rally would deter investors, But demand accelerated after the SNB cut rates to 0% in June. Why? Because the central bank sent a clear message: no return to negative rates, no heavy-handed interventions, and no more defending EUR CHF floors. SNB Chairman Martin Schlegel confirmed this, stating the barriers to reintroducing negative interest rates are very high. Swiss inflation has disappeared. In May, CPI registered negative 0.1% year-on-year, the first deflation since COVID. While this is painful for exporters, it's a green light for global capital. The franc offers stability, no inflation risk, and a central bank willing to let the currency run. This combination makes the franc unique: 0% funding and a safe haven when the world is in turmoil. In short, the franc is what the yen once was, but without the chaos and policy circus. It has far more credibility. And it's not just theory. Capital flows prove it. Sovereigns, funds, and banks are treating the franc as the new anchor. The world is already moving. It's not just Zurich policy or Swiss inflation. The rest of the world is proving the shift with real money. This year, Panama secured nearly $2.4 billion in Swiss franc loans, saving over $200 million compared to dollar borrowing. Colombia, Sri Lanka, and Kenya are doing the same math. Why pay a premium for USD when the franc is cheaper and cleaner? The crisis tape tells a similar story. When Israel struck Iran in June, the USD CHF rate initially rose, a reflex reaction to the dollar. But this movement was short-lived. Within days, the market reversed, and the franc soared to new multi-year highs. Investors weren't flocking to treasuries. The yen didn't even show up. The bid went straight to francs, and it was fast and heavy. Even banks are joining the move. Sight deposits at the SNB spiked by CHF 11.2 billion in July, pushing reserves to their highest level in over a year. Institutions aren't waiting for fury. They're already parking liquidity in francs, preparing for the next shock. Emerging market borrowers are increasingly turning to Swiss francs in their financing mix. Several EN issuers have chosen CHF in recent deals, with the IFC issuing a CHF 155 million social bond, its largest to date in this currency. The verdict is clear. The yen is burned out. The dollar is losing trust, and capital has found its new home. The franc isn't waiting for the future. It's already the safe haven of the present. The market reaction is visible. USD CHF has become the new fear gauge. When markets shake, the dollar falls, and the franc soars. USD CHF has broken down from its consolidation triangle, pointing towards fresh lows. The first target is near 0.787, with the 13-year low not far behind. With RSI still mid-range, the message is clear. CHF's strength is far from over. It's just beginning. FX desks, once reliant on JPY for carry trades, are now building structures around CHF. Even with rates at 0%, demand for Swiss francs has accelerated. The pillars of the post-war FX world are crumbling. The market needs a currency that works now, and the flows show where it's heading. The Swiss franc is the last hybrid standing: 0% money for funding and hard as stone credibility for refuge. Zurich offers what Tokyo lost and what Washington squandered. The yen's era is over, and the dollar's safe haven myth is breaking. For the first time in 70 years, the world has a new anchor, and it's Swiss.